They burned $8 billion of free cash flow since Q4 of 2019. $8 billion of free cash.
There's no question that WeWork has been a capital destruction machine. That being said, I actually think that some private equity player is going to buy this out of bankruptcy and make a fortune.
I agree with that too.
Because out of those 777 locations, a lot of them are good locations and have good tenancy. They probably generate good revenue. The problem is that the leases are just bad. And bankruptcy gives you the power to break those leases or renegotiate them.
U.S. Treasury yields pulled back on Friday after key employment data came in cooler than economists anticipated. The yield on the 2-year Treasury slid by more than 13 basis points to 4.841%. Meanwhile, the 10-year Treasury yield was down by 9 basis points to 4.577%. Throughout the week, the benchmark Treasury yield has come off recent highs that at times saw it trade above the 5% mark. Non-farm payrolls increased by 150,000 in October, while economists polled by Dow Jones expected an increase of 170,000. The unemployment rate rose to 3.9%, slightly higher than the steady 3.8% forecast. Meanwhile, average hourly earnings increased 0.2% on the month. Hourly earnings, a key measure for the expected direction of inflation, were expected by economists to climb 0.3% month over month. Chamath Palihapitiya, the CEO of Social Capital, shares his market outlook. He reflects on how the Ukraine war is affecting the U.S. economy and also his views on mutual funds and treasury yields. Now let's get into the video. Make sure to hit the like button, subscribe, and drop your comments below.
End of the fiscal year for mutual funds was October 31st. And so there was a lot of selling going into October 31 just to capitalize tax losses and tax loss harvest. But that leaves them with a lot of cash. And so starting November 1st, which is day one of the new fiscal year, mutual funds are not allowed to really own cash. That's not why you pay them. And so they're going to be active buyers. So that's why in the short term, the market is up. But if you think about the overhang of risk that we've had, right? You had one forever war and now the beginning of what potentially could be another forever war. That's definitely a dampener on market demand, right? And sentiment and investor confidence. But if a story like this is true, it actually takes one of those big risks off the table, which is this idea that now it's like every other kind of a thing, which is it's the reason we spend money there is not to win something that's winnable. It's just graft. It's just typical corruption.
Total graft. And the article says that, quote a Ukrainian official saying that people are stealing like there's no tomorrow.
Right. Right. So that the U.S. unfortunately enables in many places. That's not new. And so to the extent that that's now more of the status quo, that's reassuring for investors because we're not talking about a war. We're just talking about bleeding more money, which I'm not saying is right, but it's morally more acceptable than the alternative. So there you have it. It's generally good for markets. Now, that leaves, I think, Israel-Gaza as a risk. And I think the markets still view that as a potential war. And the longer that goes on, I think that there's a very good chance that we de-risk that as well as, again, not a war, but part of that cycle between Israel and Palestine, which is conflict, timeout, conflict, timeout, conflict, timeout. And so if what we think is now, this is just a version of conflict, timeout, and the market de-risks that, then it's actually pretty positive for equities, for startups, because now the Fed has a reason to actually say, okay, the economy is cooled off, inflation is calm, it looks like the markets are stable, let's cut rates, right? Let's reintroduce some demand into the market. It's generally a good thing. And if there's no reason to be risk off, people will use that as a reason to be risk on. What changed for the market was the Fed's rhetoric. And I think that they were holding on to this option that they were going to show up out of nowhere with another 25 or 50 basis point increase. And I think that that's fundamentally now off the table. And I think that that's really heartening for the market. That's good for the market.
Growth stocks are ripping. Affirm and Palantir are up 20% today.
Ripping.
Yeah.
Open Door, ripping. DoorDash, ripping. All these companies are up 20 and 25 and 30%. It's crazy.
It sometimes feels as if the U.S. housing market is in a never-ending affordability crisis, with prices continually rising and inventories shrinking. The reasons have ranged from anemic construction to student loan debt to investors buying up starter homes. But even as the pandemic pushed values up faster than ever, cheap mortgages kept buyers in the game. Now a whole new affordability crisis is beginning, and this time there's no obvious way out. Friedberg and Sachs delve into the housing and real estate crisis and offer their analysis of the situation. Let's now hear what they have to say.
There's, $3 trillion of commercial real estate loans sitting out on commercial banks' balance sheets in the US today. 3 trillion. It's an insane number. And we were all talking over text the other day, as you guys know, about this building that's being shopped and got some attention on Twitter. I think it's 115 Sansom. You guys know this building? I've lived in San Francisco for how long have I lived there? 20 some odd years now. So I know this building. And it's a 125,000 square foot building that's going to likely be fully vacant in, call it, 2 to 3 years. So the guy puts it up for sale, the equity owner. He puts the building up for sale, and he's basically like running an auction on it. And the brokers are all saying, hey, it's currently at $199 a square foot, which translates to $25 million. It'll probably get done at $300 a square foot, which is about $38 million for the building. The problem is, if you look at the debt on the building, there's $53 million of debt. B of A owns that note. So Bank of America in 2016 issued a $54 million note on this building. If this deal closes at $39 million, the equity owner who's running this auction to sell the building makes $0. All that happens is that money pays down the debt, and the debt only gets 70 cents on the dollar, and B of A has to take a write down on the rest. So there's a rumor that in this particular case, what's happening is the equity owner of the building is putting it up for auction to show the bank, hey, this thing's only worth 70 cents on the dollar for you on your debt. You should restructure my debt. So apparently there have been a lot of building owners that have been going to their banks and saying, hey, I want to restructure my note. I want to have longer payment terms. I want to keep the rates lower for longer. I want to have some of the debt forgiven. Anything they can do to get the cost of the debt down, because the overhang of the debt on all these buildings is so significant. These buildings cannot make money and the owners will never make money. So they're like, why am I even wasting my time? So they have one option, which is to hand the keys back to the bank and say, here you go, you auction it and sell it. Good luck. And the other option is to go to the bank and say, hey, restructure my debt. Let's figure out a deal. Here's the problem. The $3 trillion of debt that we just mentioned that's sitting on all the banks' balance sheets is all being held at par. They're not discounting it at all, and they're not marking it as being impaired in any way. So as soon as they have to start writing this stuff down, the bank's balance sheets all get impaired. And so there's a real risk in the market that I don't think has been fully accounted for, that we're starting to see the cracks. And to Chamath's point, this might accelerate either Fed action, or, as I've mentioned in the past, I think the federal government steps in and starts to issue programs to support commercial real estate developers and owners. Sachs, I know you've been following this quite a bit. Maybe you could share your point of view, and if I'm off on this, in terms of how significant of a problem this is, how much of the $3 trillion of debt really is impaired, and by how much should it be impaired, do we think?
Massively. I think it's a huge problem. If you talk to anybody, any of these commercial real estate developers or sponsors, they'll tell you many of them are just kind of hanging on by their fingernails. I mean, it's really ugly. And you know how distressed things are when you actually look at some of these sales. That same account on Twitter that you posted, he's got like a tweet storm here showing about half a dozen of these sales that have happened in the last few months. And buildings are now selling for $200 to $300 a square foot in San Francisco. These are buildings that could have sold for $1,000 a foot, a couple of years ago. And now they're selling for $200 to $300. The replacement cost, if you were to try and recreate these buildings from scratch, given how expensive it is to build in San Francisco and how complicated the entitlements process is, probably be $1,200 plus a foot. So these buildings are selling for 10 to 20% of their replacement cost. These are fire sales.
Realtors have long been seen as the major mediators between buyers and sellers in the real estate sector. However, recent digital advancements, such as a high-profile case involving real estate firm Zillow, have sparked concerns about the potential disruption of the realtor sector. A recent ruling in a Missouri case against the National Association of Realtors, NAR, has sent shockwaves through the real estate industry. The jury awarded almost $1.8 billion in damages and found that the NAR had engaged in collusion to maintain high brokerage commissions. This decision adds to the mounting scrutiny on how real estate agents are compensated, with the Justice Department also investigating the commission-sharing system. The traditional real estate commission model typically requires home sellers to pay 5% to 6% commission, split between their agent and the buyer's agent. If the federal government were to ban commission sharing, it would disrupt a long-standing industry practice. This potential shift comes at a time when the U.S. real estate market is already facing challenges, with rising mortgage rates and sluggish home sales. While this particular lawsuit does not directly influence the Justice Department's stance, it revolves around similar issues. The Justice Department has recently taken an interest in a Massachusetts case related to traditional commissions. This involvement suggests that the regulator is actively monitoring the situation. In response to the ruling, real estate stocks including Zillow, Compass, and Redfin experienced significant declines. The combination of these lawsuits poses a significant challenge to the unique U.S. commission system. However, the most substantial threat to the industry would be a case brought by the Justice Department, potentially dismantling the commission-sharing structure entirely. The real estate industry faces an uncertain future as it navigates these legal challenges and the potential for significant reform. What do you think about the housing market? Things are far from rosy and there is no solution in sight. Let us know what you think in the comment section below. Also, don't forget to hit the like button, subscribe, and turn on notifications.